Well, thanks so much for tuning into this conversation with Chalet Hotels. Remember, for the hotel space at large, the extent of growth in ARRs may vary, the extent of occupancy rates may vary, what each company's done on the EBITDA front may vary. But if there was a common trait that came out, at least in quarter one, maybe to an extent even in quarter three of last year, so to say, was that there is a revival, and that revival may likely stay stronger for longer. Let's ask if that is indeed the case to Mr. Sanjay Sethi of Chalet Hotels. His company came out with a fabulous set of numbers, and we'll talk a bit about Q1 as well. But Mr. Sethi, great having you. Thanks so much for joining in. Can I start off with that macro question? Do you sense that this revival that you've seen, and in your case, Q1 was the strongest ever, but do you see this revival staying stronger for longer?
Neeraj, good morning and pleasure to be here. Yes, I think the revival is here to stay. In fact, it'll get better from here onwards because of two things. The regular business is back. This revival is not on the back of ad hoc or pent-up demand. So this is regular business, at least for our portfolio, which is largely business travel focused or MICE focused. It's regular business coming back and driven today by the domestic business travelers. Largely, in fact, domestic business travel was up 2x in Q1 this year compared to Q1 of FY20, the pre-pandemic days. So that's a very strong growth on the domestic business side and by the MICE segment, including weddings. So these were the two sort of segments that sort of propped up the business. One segment that has not caught up to pre-pandemic days clearly is the foreign business travel. And on that, whilst we see that the numbers from UK seem to be very strong and very close to pre-pandemic number. But UK had a smaller pie of the foreign business travelers coming to India. The largest pie was with the US, ranging between 50 and 60%, depending on which city you look at. They are not back as strongly as that. In fact, they are only at about 40% of pre-pandemic numbers. And that's driven by two things which will get sorted out in a very short period of time. One is the visa problems that people are having because the embassies and consulates were shut down for very long. It's taken time to revive that process, those processes, that's falling into play. Second, and which is more critical, is the airline connectivity. So whilst Europe, UK have direct flights into India for too long a time, at least into Mumbai, Hyderabad, and Bangalore, there are no direct flights from US right now as we speak. There used to be several, there used to be multiple in a day, and right now there's not one single flight coming. The encouraging part is, and that's been driven by two things again. One, of course, the whole demand pattern on the supply challenges the airlines are facing. Second, with the airspace shutdown of the Northern Hemisphere, the route that they used to take over the North Pole is restricted. So they have to take a longer route to come in through the West to East Hemisphere. Which is led them to wait and watch on this front. But now they've announced their schedules, September onwards to Bangalore and Hyderabad. I think Mumbai, I'm waiting for the final schedules on that. When this kicks in and that comes back to 100% of where we were pre-pandemic, I think there's going to be the next large step up in occupancies and rates.
Wow. What goes behind this number of 2x pre-pandemic? I mean, surely businesses and the economy haven't grown as strongly for people to do that. So could it be, and pent-up demand, I don't know if it can lead to so much. So my question to you is, have you tried to analyze what goes behind this and how sustainable is it?
So, Neeraj, business travel is not driven by pent-up demand. You can have pent-up demand for a week. You won't have it for months at a stretch, right? Leisure can have it, weddings can have it, but not business travel. Even events, conference and events can have it. But regular business travel is not driven by pent-up demand. It's driven by natural demand growth. So there's been three years of demand that is the growth that is sort of creeped in over these 3 years. Our supply has been almost zero, increase in supply. So that's what's caused this to happen to a large extent. Plus, there's been a migration of travel from lower and mid-segment hotels to higher category hotels, purely because of the comfort that travelers draw with the hygiene and safety elements in there.
And there could be a permanence to both of these aspects, at least a permanence to the safety and hygiene piece.
Absolutely.
And a near-term steadiness on the supply side deficiency as well.
True. In fact, the expected growth in supply is only about 4.5% CAGR for the next 5 years, which is extremely low compared to the growth in demand. We expect the demand to grow in actually double digits. So that's the sort of gap that we're going to be facing, the supply and demand, favorable for the hotel industry. And I see rates sort of stepping up very sharply on account of that.
Wow. So, okay, as a traveler, I'm concerned now. Would the ARRs be moving up substantially, and would we have to fight for occupancies at some point of time in the next 12 months?
These are just all a matter of perception. Our ARRs are 30% discounted to 2008 ARRs, right? And they've been 13 years, or 14, 15 years now since then. If you think the hotel industry should not be, sort of building in an inflationary element into the ADRs, I think it'll be impossible for us to survive. That's one. The second reference point is, where is India's ADRs compared to the rest of the world? In dollar terms, we are $120, $130 at the best hotels in the bigger cities for business travel, not leisure, right? Any big city across the world, even if you go to the third world countries, they are in the range of $150 to $250. So we are heavily discounted on a global reference point, and we are discounted to 2008 rates also. The natural movement with the demand outpacing supply is going to be to stabilize the rates to what global rates are.
Sure. And just wondering, I know it's always difficult and fraught with risks to predict, but I'm still trying to understand. When do you, in your experience and judgment, believe this uptick will start showing up meaningfully?
I think it's going to start from the start of the H2 and of this year. And I think the next year, you're going to see a fairly good amount of step-ups in the industry as a whole.
Wow. And so Mr. Sethi, here's a question. I'm trying to weave multiple things into one, but I looked at all the estimates that people had at the start of the year for other companies and for your company on the EBITDA front. I see that hotel companies during the COVID period have brought down costs quite materially. So if there is a cost reset that has happened, which will go up proportionate to the whatever that you have to, but at the same time, if we are looking at higher occupancies and higher ARRs for the next 6 quarters at least, if not more, are we in? Is the analyst community in for a bit of an earnings surprise over the course of the next 6 quarters?
Okay, let me sort of take you back a couple of quarters back. Whilst the rest of the Indian consulting and analyst community was predicting India coming back to normal earliest by FY24, maybe in FY25, we were saying it's going to happen in H2 of 23. I was proven wrong. It started in Q1 of 23. So even in comparison, even I was pessimistic. So I think we've beaten that prediction by quite a margin. So the revenue side is likely to grow far higher than most people have estimated. There will be a step up in revenue driven by high occupancies leading to higher rates, because once the occupancies across India start hitting 70%, you're in for a step up on rates. Chalet is already at 72, 73, even if you discount the IPL part of the business that came in Q1. We were at the similar number pre-pandemic, and the rates had started going up at that point of time. So we see now rates going up. And as I said, once the US travel is back, starting October of this year, that's when you see a segment mix improving and therefore average rates going up. So that's one. On the cost side, you're right. The lessons that the industry has learned during the pandemic, being frugal, on being smart about costs, and very importantly, being agile and flexible on the cost side, is going to come in play for the years to come now. Most companies have been able to bring down their operating costs, including fixed costs, by a reasonable margin. If you look at Q1 numbers for us, for example, I think a good reference point is revenue was marginally higher than Q1 of 2020. But look at my cost share. If I was to, in fact, read some numbers for you, an interesting element is that in 2019-20, my payroll cost to revenue percentage was 15 for Q1, right? We were 13 this last quarter. Revenue is being flat. And in that, I have absorbed increments for 3 years, right? Second thing, reference point is what was my utility cost, which is the second largest operating cost after payroll costs. My utility cost in 1920 was, for the same quarter, was 7% of revenue. It's 6% of revenue in this quarter. Now, if you've got a saving of 300 bips on revenue to margins, you're clearly improving margins significantly. And I think that's reflected in the EBITDA margins that we've been able to throw up this quarter. This quarter and the quarter two are not the best quarters in the year. And for us to hit 40 plus EBITDA margins in Q1 just indicates that we've been able to institutionalize some of the cost rationalization that we did during the period.
The significance of this statement, Mr. Sethi, is that if I annualize what you've done in quarter one, where you say that Q1 is arguably not the strongest on the EBITDA front, that is, you will do what people expect you to do in FY24 in FY23 itself.
Yeah, a little bit of a caveat there. We did have the benefit of the IPL for 50 days in that quarter till 20th of May. So the Mumbai hotels, a large part of inventory is in Mumbai, was supported by IPL. So we've got to leave that out. But if you look at our June numbers, and I think we gave an indication in July also, both were trending in the 72-73% occupancy mark, and the rates are growing actually. So I think it'll be slightly discounted to Q1 for Q2, but I don't want to give a forward-looking statement. But the June trend indicated that in any case from Q1. But H2 should be very strong.
Got it. Mr. Sethi, a word on the non-hospitality business, because you are, I think you are waiting for some permissions for the residential project. I think it's a one-off, as you told me, and the hospitality and the commercial projects, I believe. I think if I'm not wrong, you mentioned that except for that one Sahar piece, most things are kind of leased out.
No, actually, it's a little different. Let me talk you through this. So on the residential project, it's something that was lying with us for last 10 years now, 11 years actually. And residential, as you know, is build and sell. So you exit that business. We were stuck on some approvals. We were in litigation with the approving authority in Bangalore on the height restrictions. That's come through. I mean, that's been cleared now, that litigation. And we have now progressing on the project. Most of the approvals are in. We're waiting for the final approval to start selling the apartments again. So that's the real approval that has to come in. And we've got one more small approval to come in before we go full-fledged into the project. But this is large inventory, 200 plus apartments still to sell. 80 were pre-sold. Those buyers continue to have strong faith in this and continue to stay on the project. It's a luxury project. It's Vivaria branding, which is the best, one of the best brands in Mumbai today from the group. And therefore, it'll get quite a premium. That will build and sell and exit, right? So that's going to be one-off activity. On the office side or the commercial side, this is more of an operating play. And the philosophy behind this is the following. If I have 11 acres of land at Sahar, where my JW Marriott is, or 17 acres at Powai, where my Western Mumbai is, and if I don't want to build more rooms because I'll be oversupplying the market, do I want to leave the land unutilized? Clearly, we don't. Getting more FSI, buying more FSI is low cost. You build on it and get high-yielding assets under the alternate asset class. And there we've looked at commercial because the group's strength is in that. More than 30 million square foot is within the REIT. They're building another 1 and 2 million square foot a year. Today, our operating assets out of the 3 million that we've announced is about 600,000 square feet. All of it at JW Marriott Sahar, actually. The ones that are under development is Bangalore, where within the Marriott Whitefield compound, we've got about 1 million square foot of leasable space coming up. It's going to be, the new tower is going to be ready by October, and the converted mall into office is going to be ready by November, December. So that combined together is lit around 1 million square foot, a little shy of 1 million square feet. So that's going to come into play. And then Powai, we've got a building which is about 750,000 square foot, which is now facade is being put up. So the building is almost complete. That should be ready by end of this financial year. Now, this is a high demand market, high rates, and high margins. I mean, typically the office business yields around 90% EBITDA margins. And at high renters, the flow through is very, very strong. And then we've got a second tower which we announced, but we haven't started construction on, which we'll do at the right time after the approvals come in. So overall 3 million square foot, 600,000 under play. Another 1.6 million will be ready by end of the financial year. And that will leave us with 800,000 roughly to be built once we do the third tower at Powai.
Okay. So,
and I must highlight here, they are complementary assets. They actually create demand from hotels.
Yeah. Okay, great. So which helps. So my final question, and I can get into a long conversation around the net debt position, but I think you explained it beautifully in the con call, so I'm not going to get into that. My final question, therefore, is that what is the normal growth of business which you spoke about in the hospitality, which is a large part of your revenue any which ways, and step-ups that come in if indeed business style were to pick up, hopefully it does. But the other bit is the improvement in revenue that comes in because of added capacities coming in. You've outlined a bunch of capex fruitions happening over the course of the next 24 months. Is there a steady state uptick in revenue that happens because of newer supply at your end coming into play as well over the next 24 months?
Absolutely. In fact, we've got some very exciting projects that are on the underway right now. We've got the completion of the second Westin Hotel in Hyderabad with 168 keys, which will be ready by January or definitely between the last quarter of this year. That's one. Second, we are adding 88 rooms at Pune, which will take the inventory to 311 rooms. We were completing the renovation at Powai, which right now 120 rooms are out of action for the renovation. And the banquet hall was out of action for some time. The banquet hall has been handed back. Brand new banquet hall, really stunning actually. And it's the preferred location for my segment. So that's going to come into play now. And then we've announced a new deal at Delhi International Airport Limited, where we've signed up the lease, a shell lease, where they will build the shell and give it to us to run roughly a 375 to 400 room hotel. We're in discussion with a couple of brands right now to sign a franchise agreement. We'll run that hotel on our own. That's really exciting because the market is very strong. This is going to be a terminal hotel. You actually walk in it from the terminal with your bags into the hotel. It's very seamless. And typically, terminal hotels across the globe do high 90% occupancies because the turnover of the room is more than once a day in many cases. That's the other exciting one. We've also got the Hyatt Regency, a 260-room Hyatt Regency in Navi Mumbai, which we haven't started work on. We wanted to see demand build up before I commit to that hotel. And I think with if the US flights start coming in the next couple of months, that'll give us a lot more confidence to adding more inventory in that particular market. We already have 152 rooms there. And also we're closely watching leasing traction in that market to see which way that's headed for generational room night demands. So that'll be another 260 rooms. So there's enough happening. We are also looking at other growth opportunities in new cities, but we're not looking at 30, 40, 50, 100 room hotels. We're looking at bigger boxes because that's our DNA and that's something that's worked for us over the years. We'd like to stick to that.
We wish you all the best for that, and it'll be lovely to get some updates around the festive season when you come out with your next quarter numbers, Mr. Sethi. But congrats on a fabulous quarter.
Thank you, Neeraj. All the best.
Yeah, thank you, and the pleasure was ours talking to you. Viewers, thanks for tuning in.